U.S. natural gas futures rebounded on Monday, on expectations that LNG exports would increase. Due to the end of maintenance outages in plants including Berkshire Hathaway Energy, Cove Point LNG and Freeport LNG. Still, prices fell almost 60% in the past 9 weeks and remain close to 7-month lows, due to forecasts of lower weather-driven demand. Record domestic production levels and reduced liquefied natural gas exports that allowed utilities to inject more gas into storage. Average U.S. gas demand, including exports, is expected to rise to 97.1 billion cubic feet per day next week, from 93.9 billion this week, below Refinitive's outlook on Friday. Meanwhile, average gas output in the U.S. lower 48 states rose to 99.5 billion cubic feet per day so far in October from a record 99.4 billion in September. The weekend weather data remained exceptionally bearish and was still with more than 50 HDDs warmer than normal through the first week of November. Researchers highlighted that the National Oceanic and Atmospheric Administration is forecasting above-average temperatures this winter in most of the country, except for the Pacific Northwest and West North Central region. Meanwhile, dry natural gas production is forecast to increase over the winter period by 3.2% above last winter levels to 99.1 billion cubic feet per day. The natural gas storage withdrawal season, which takes place from November to March, is forecast to see withdrawals totaling 2 trillion cubic feet, or 11% less than the last winter withdrawal season. Winter demand for natural gas is expected to increase 2.4% over last winter levels to 121 billion cubic feet per day, driven primarily by growth in demand for natural gas exports. Overall, looks like the market is trying to price in some type of massive global recession, which obviously is going to drive down demand for natural gas. Because of this, you should be very cautious with natural gas trading, because sometimes the bear market rallies are absolutely brutal.